Judging from what Steve has told us about the Fed chair's rather bleak assessment of the economy, specifically the job market, do you see any reason to change what you're doing in terms of investments?
No, I don't think so. And I think the message today in the Q&A will be pretty consistent with what Chair Powell has said over the past number of months. And you guys really touched on it. I mean, it's the labor market and it's inflation. And I think, in terms of the labor market, the Fed's made it pretty clear that they're not going to do anything with interest rates until the labor market reaches their definition of full employment. Now, you can try to define exactly what that means. But I think if you look at unemployment rates, participation rates, various surveys, I mean, it could take a number of years for the labor market to heal naturally and reach that level. You can make the argument, as Janet Yellen has, that it will reach that a little bit quicker. But I think that's if you get the additional fiscal stimulus that's been proposed. And then on the inflation side, you got CPI readings today, both core CPI and headline CPI, 1.4% year over year. So nothing necessarily alarming there. You will lap some pretty weak inflation readings from last year. So I think you maybe get a little bit of an inflation scare as you move through maybe the halfway point of 2021. But you still have an output gap in the economy that's pretty wide. If you look at potential GDP versus where GDP is, again, still wide. So it would be unusual to see a really sharp spike in inflation, at least this year, given those conditions. I think you look a little bit further out, and that's where the question marks start to arise.
Maybe you just answered my next question in your reference to inflation, but when you have an economy that is roughly, $20 trillion in total output, and you have stimulus on the order of $7 trillion or something like that over the last year, so that's sort of 40% basically, or 35% of economic output. What kind of problems are you looking at down the road, if any?
Yeah, it's hard not to be a little bit concerned. I mean, this is now well cited, but M2 money supply up over 26% year over year. Additional stimulus likely coming down the pipe here. I mean, you have the stimulus that we already received via the CARES Act. You have the $900 billion that we already received. And now I think it's very likely that you get stimulus more in the order of $1.9 trillion. Versus maybe some of the lower expectations that had been cited. I think things have changed on the stimulus front in terms of some of the more moderate Democrats actually being willing to go for the full $1.9 trillion as long as certain things aren't included in the bill. I think Democrats are now looking at a 2003 precedent that was set via the inclusion of some Pell Grants in a reconciliation bill. So you might actually be able to authorize some additional discretionary spending in the next round of fiscal stimulus. And this is now at almost 6% unemployment. Yes, you have issues with the participation rate, but all of these things are flooding into the market. And I think there's a very good reason to believe that, you look past this year, things start to tighten up a little bit from a supply-demand perspective, and you could see serious issues with inflation. What I will say, and what I'm telling our clients, is that it's probably not an issue this year, but if you look at what hedges inflation the best, it probably is equities. They do a lot more. They do a much more consistent job of hedging inflation than gold and even commodities. The beta of the S&P 500 to inflation expectations has been kind of the most consistently negative over the past number of decades. So just given the backdrop as it relates to liquidity and the fact that we don't think inflation is going to cause the Fed to move now, we still want to be fully invested in the equity market.
Shepard Smith here. Thanks for watching CNBC on YouTube.